Joel Greenblatt is one of the most successful investors ever. Stick around to the end of the video to hear why he thinks these stocks will crush the S&P 500 in the coming 2 years. Greenblatt started his fund Gotham Capital in 1985, and in the coming decade he made an average return about 50% per year. Greenblatt's investing style has changed from when he started, and he today uses something called the magic formula. This formula became widely popular in the investing community when it first appeared in Greenblatt's book, The Little Book That Still Beats the Market. It was when Greenblatt's fund backtested different investing formulas that they found that the magic formula, the simple magic formula, was the one that performed the best. So how does the formula work? The formula consists of only two metrics. The first one is sort of an earnings yield. It's called Gotham yield. And the second one is return on invested capital. The higher these two metrics are, the better. So what you want to look for are stocks that score high on these two metrics, but that can be quite time costly to look through all the stocks. So here comes the best part. Instead of you manually looking for stocks that score high on these metrics, Greenblatt has made a stock screener that does it for you. On the website Magic Formula Investing, you can see the top scoring stocks on these two metrics. And it is totally free as well, and I will show you why this formula is very interesting right now and show you how the website works. The Greenblatt recently did an interview where he talked about how value stocks are trading at very low prices at the moment. This is based on the research his fund Gotham Capital has done. This research is also free to the public, and I will show you it right now. What we see on the y-axis is the 2-year average return, and on the x-axis, the Gotham yield, which is a slightly modified version of the free cash flow yield. The blue squares you see are different time periods. What a chart shows is that there is a correlation between how high the earnings yield is and how high the future return is. And as you can tell, the higher the earnings yield is, the higher the future return is. But not all stocks are calculated in this chart, only the 20% least expensive based on 1,400 stocks, so around 250 to 300. So only the cheapest ones, so to speak. As you see on the screen right now, this chart shows that we are in the 95th percentile towards cheap. And based on historical data, when the earnings yield has been as it is today, the 2-year average return has been or will be almost 66%. This is why I find the magic formula right now to be of extra interest. Of course, you can't predict future returns based solely on historical data, but it's still interesting to see how cheap value stocks are trading at the current moment. I will leave links down below on all these websites that I'm using, but now on how to use the magic formula. So you go in, click on the number of stocks you want, and the minimum market cap of these stocks. Then the formula does its magic and boom, there you go. 30 undervalued stocks based on these metrics. I can just mention that financial industry stocks and utility stocks will not appear because of the special nature of the industries their companies are working in. But besides that, all types of companies will appear. On the website, they say that you should buy at least 20 of the stocks that appear to diversify. The magic formula is updated every day, so you will see stocks coming in and other stocks coming out. But this usually happens if a stock price goes up a lot, so it's not cheap anymore, or if there's a new quarterly report that comes in. This is the way it's intended to be used and the way it was presented in the book, The Little Book That Beats the Market. But I will try a slightly different approach. By going through the list, you will see that a lot of these stocks are in the pharma industry or the energy industry as of right now. And I do not particularly like those industries. Both industries can be really profitable, but it can also be quite unreliable because there are patents and energy companies are only as good as the energy prices and they don't set them. And I also don't find them to be very near my circle of competence. Because of that, I have slimmed down the number of stocks to 11, which were the ones I found interesting. I analyzed all these companies, but quite quickly, but what I found was quite interesting. So all these companies have low or no debt on the balance sheet. really high cash flow yields, and a lot of them has a lot of cash. What I will do is I will buy these stocks to test if they outperform the rest of the market, and then make a future video in maybe 6 months to a year's time and show what performance they did. The 11 companies are on the screen now. What I represented now is not the way the magic formula was intended to be used. So instead of just buying the entire basket of companies, I have chosen the ones and handpicked them. So I've used the stock screener more to get stock ideas and use those stock ideas to make a more concentrated portfolio. So you can use the magic formula to get stock ideas, and based on those ideas then pick the ones you like and do a lot of research on it. And that might be just one of all the 50 listed. Or you could buy the entire basket. It depends on what fits you. And we will see how things turn out. So check out the website, and who knows, maybe you will find 1 or 2 stock ideas, or maybe even more. And I hope you found value in today's video, and I will see you in the next one.